Okay. Hey, here we are, back together again, which is the way that it's supposed to be. Isn't that nice? I didn't give you any homework as far as paper and pencil, did I? Okay. But I want to remind you to do that 15-point chapter 16 cash flow, like a mini project through Connect. And again, that's 15 standalone points towards your overall grade in this class. And then I also gave you a chapter 17 25-point mini project, right? Which is also standalone points. Okay, those two things do not go into your Connect points. They're 15 points and 25 points respectively that go towards your overall grade. Everybody understand that? And on the chapter 17 one, you know, use your book as well when you do that. Okay, don't just use the slides, but use you know, the information that you have in your book as well. They have a very nice, let me point it out. I don't think I pointed it out last time, but if you haven't done it already, and if you read the chapter, you saw this, but they have exhibit 1716 in your book, okay, where they list out all the ratios. So don't just use the slides when you do that project, but use your textbook as well, okay? So, all right, let's go ahead and get started here. We are going to start on chapter 18. Chapter 18, which is called Managerial Concepts, Managerial Accounting Concepts and Principles. Okay, you can come off that for a second. We started to kind of make a shift in this class in the last couple of lectures, okay? Accounting 2 is almost like two separate classes. The first half of it, which we are now done with, the first half of it is like a continuation of financial accounting, okay? The second half of it, where we're kind of starting now, but maybe started a couple lectures ago technically, is kind of a precursor to managerial accounting, okay? Now, how many of you have to take managerial accounting eventually? Okay, more than half of you. So everything you learn from here to the rest of the semester, you will be doubly blessed with, because you will be going over this in greater detail and greater depth in managerial accounting. And I kind of talked about that as far as chapter 16 and 17 as well, right? You'll readdress those subjects of the cash flow statement and financial statement analysis. And you'll have a little bit more time to go in a little bit more depth, okay? So we are going to start talking today about managerial accounting. Let me show you this first slide here, okay? Financial accounting, which is what you did in Accounting 1 and up till now in this class. This is accounting that provides information to external users, such as stockholders, creditors, potential creditors, okay? Those that are outside of the organization, okay? That's financial accounting. Now, what is managerial accounting? What is this subject of managerial accounting that we're going to start? It provides information for managers of an organization who are going to plan and control the operations of it, okay? This is managerial accounting is for the managers, okay? Makes sense. Let me give you a little bit of an analogy here, okay? Nobody here's married, are they? No? You are, Matt? Yeah. I didn't know that. Okay. How long have you been married?
Almost a year and a half.
Okay. Are you far enough in your marriage where you guys do finances and stuff together and tax returns and all that?
Yeah.
Okay. Well, Matt, let me use an analogy that might kind of clarify this financial versus managerial accounting, okay? Have you guys done a tax return together yet? Okay. When you did a tax return, think about that. Why did you do that tax return?
Because we legally had to pay taxes.
Because you have to, right? And who did you do that tax return for?
Federal and state.
Federal and for state, for the government, right? And are there lots of specific rules about how you do your taxes? Yes, there are, right? And when you did your taxes, you and your wife pretty much, you probably did them in the early part of the year and you looked at the previous year as a whole, correct? Okay? But you kind of have to do it, right? You're doing it for external users. That's kind of like financial accounting, okay? You and your bride doing your taxes is analogous to financial accounting. There's a lot of rules. You're doing it for somebody outside of the company. You're usually looking at past information, okay? Let's talk about managerial accounting. Now, I don't know if you and your wife do this, but sometime in your marriage, you'll probably start doing things like where you get together and kind of financially plan out the next year or look at your finances together. Do you do that at all? Mm-hmm. Okay. So let's say you and your wife sit down and plan out a budget, okay? Plan out a budget for the next year or a portion of the year or whatever. Are you required to do that by any outside agency? No. You can do it. You cannot do it. Are there lots of rules about how you do it if you choose to? No. You want to make a category for, Royals tickets in your expense budget? Make a category for Royals tickets, right? You can do what you want because it's just you and your wife managing the entity that is your little family, right? So it's very flexible, okay? Now, you don't just look in the past, though, with that sort of a situation, do you? You're doing a lot of talking about the future. Like, well, what do we want to be in a year? What should we save for the future? What should we, let's start saving up for holiday gifts or whatever, right? You're looking at the future. You're looking at the past, but it's very flexible, correct? You also may not look at your entire finances, but you may just decide to do a budget, for example, for vacation. Maybe you're going to take a vacation between semesters, a ski trip or something. And so you do a budget for that ski trip, okay? But that whole situation is analogous to managerial accounting. Does that make sense? Okay? Let's take a look at this next chart, and this chart is in your book, and I think that'll help clarify it too. This is financial accounting. This is managerial accounting, okay? Now, as I said, financial accounting deals with external users. Managerial accounting has to do with those internal to the company, okay? The purpose for financial is to make investment, credit, and other decisions, whereas managerial, it's to plan and make decisions in regards to running your company. Financial accounting is very structured, lots of rules. Sometimes we say financial accounting is very black and white, okay? Managerial accounting is relatively flexible, or we might say it's more gray, okay? It's more gray, just like when you do your budget. It's not a lot of rules. Timeliness. Financial accounting, a lot of times, is only available after the year is done and after the audit is complete. Whereas with managerial, there's no need to wait on any sort of official audit or anything, right? Okay? Financial accounting mainly looks at the past history. They may do they'll do some predictions, but it's mainly looking at historical information. Whereas with managerial accounting, there's lots of projections and estimates that you make. Okay? The focus of financial accounting is on the whole organization, whereas managerial might just look at a segment. Okay? Similar to the way maybe you just did a budget for your vacation. The nature of information in financial is usually just strictly monetary. Whereas in, did I say that right? For financial accounting, it's strictly monetary. For managerial accounting, though, you often bring a lot of non-monetary information in there as well. Such as, well, if you and your wife, Matt, were planning out a vacation, you would say, well, where do we think we would enjoy going to the most, right? And, what's the weather going to be? And would we rather go on one big vacation this next year or two smaller vacations, right? But there's a lot more of that sort of a discussion in managerial. In a business, you would bring into concepts as far as like, how will our customers react to this change? Or, are our vendors going to be happy if we, that sort of thing. So there's a lot of non-monetary information that's discussed there as well. Does that kind of clarify it? Okay. Now, your book on page 749 and 750, let me double check to see if those pages are right. Page 749 to 750. Yeah, that's correct. 749 to 750. It lists some terms here. Now, I'm not going to read those terms to you, okay, and the definitions. You can read those, but I think I have a homework question on that, either on paper and pencil homework or on a Connect assignment. And I usually do have a few multiple choice over those. And there's a good chance you've talked about some of these things in other classes as well. Okay, so take a look at those on those 2 pages. All right. Okay, cost classification. Oh, this is such an important subject that I'm going to put a star there and even a star over on the other side as well. This is extremely important. Being able to classify costs. Okay, see this illustration here? Okay, where there's one guy in the middle of a circle and they're looking at him from a bunch of different angles. Keep that in mind with the analogy here that I use. Okay? Let's think of Jeremiah, you'll be our example, okay? Jeremiah is one person, correct? But there's a lot of different ways we could classify you. Is that correct? Mm-hmm. We could say, is he male or female? He's male, obviously. Is he a full-time student or is he a part-time student? Full-time. Full-time, okay? We could say, you don't have to answer all these questions too, okay? We could say, what age group does he fall into, correct? We could say, what religion are you, correct? We could say, what's your ethnicity, right? We could say, what income bracket does he fall into? Poor. Right, poor, okay? We could say, where do you live? But do you see that this is the same guy that we're analyzing, but we're just classifying him in a lot of different ways. Is that correct? Same guy. Just depends on how we're classifying him. Well, costs are the same way in looking at that slide. We can look at a cost and classify it in a lot of different ways, okay? One way that's extremely important that we're going to classify things is by behavior, okay? Specifically, how that cost reacts to changes in activity levels within what we call the relevant range. Now, total variable costs change as activity changes. Total fixed costs remain unchanged as activity changes. Say that again. Total variable costs change as activity changes. Total fixed costs remain unchanged as activity changes. If you wanted to look on it as a graph, variable costs look like this. As activity changes, as activity increases, our costs change and increase, right? Whereas with fixed costs, as activity changes, fixed costs, it stays the same, regardless of that level of activity. You with me? Let me give you an example, okay? Mackenzie, let's say that you were engaged, okay? And let's say you were planning out your wedding, okay? Well, let's say, do you see where catering, the amount that you would spend on catering would be a variable cost? And what would it vary in regards to? Well, that and also the amount of people that you invite, okay? The more people you have at your wedding reception, the more you'll spend on catering. Agreed? Mm-hmm. Okay, that's a variable cost. Whereas an example of a fixed cost in this situation might be, let's say you pay $1,000 to rent a reception hall. Okay, it's $1,000 for that evening. Well, whether you have 100 people there or 200 people there or 300 people there, it's $1,000. Does that make sense? That is a fixed cost. It does not change in regards to the number of people that you have at your wedding reception. Okay? Now, look back at this slide because I want to point out something that's important. This little phrase here that says within the relevant range. Where's my pointer? Now, there is some level of relevancy that when I do that example with Mackenzie's wedding reception, we have to stay within it. For example, there is some number of people that, I mean, if you have 25,000 people at your wedding reception, you can't even be at that hall, right? But that's not the relevant range. You're not going to have 25,000 people at your wedding. You see what I'm saying? So sometimes people take these costs or these examples, they take it to the ridiculous and say, well, couldn't it be? Well, we're saying within the relevant range. Does that make sense? Okay. So it seems very easy to classify costs based on fixed or variable. But we're going to work on a worksheet here in class, and we'll go through it, and I'll talk to you about some of the pitfalls sometimes that students have when trying to classify costs as fixed or variable. Okay? So what we're going to do now is we're going to take a little class time. You folks at home, as always, you do this with us, and you have this in your packet. But we are going to work on the fixed versus variable costs handout. Just do the entire handout. They'll play that music for you, and we'll go with it, okay? So we'll see you in a few minutes. You folks at home do this as well. Do your whole page of fixed and variable costs handout. All right, let's go through it. If you folks at home aren't done, just pause this and push play when you are done. Let's go through these. Listed below are costs for the production and sales of soccer balls. Classify each cost as variable or fixed, okay? All right, leather covers for soccer balls. Variable, right? The more soccer balls you produce, the more you'll spend on leather covers, okay? Annual flat fee paid for office security?
Fixed.
Fixed. Shipping costs of completed soccer balls to customers?
Variable.
That would be variable, okay? The more you sell, the more your shipping costs will be in total. Laces to hold the leather together?
Variable.
That would be variable. Depreciation on the drill press. That's the straight line method.
Fixed.
Okay. That would be fixed, okay? Regardless of how many soccer balls you produce, it's going to be the same amount, okay? Property taxes on the factory.
Variable.
I heard both.
Variable. Couldn't it be different?
Okay,
It's the same
you played right into my hands, okay? This is fixed, okay? And let me tell you why some people think it is variable, okay? Incorrectly think it's variable, but understandably, okay? What they say is this: well, your property taxes you paid in 2012 are different than what you paid in 2013, which is different than what you pay in 2014. Thus they vary. They're different every year, thus they're variable costs. Well, I agree with what you said, but that is not our definition of a variable cost. Our definition of a variable cost is, does it change in the level of activity for the production and sales of soccer balls?
Okay.
Does that make sense? So it's very easy to make that mistake. But what I always ask myself is this: if I decide to produce and sell 1,000 more soccer balls, would that change the property taxes on the factory for that period? It wouldn't, would it? Okay, so that is a good example of that situation, that pitfall. Okay, so that's fixed. Number 6 is fixed. Wages of assembly line workers.
Variable.
Variable. Okay. Factory manager salary.
Fixed.
Fixed. Any questions on those? Let's go to the next one. State whether each of the following would more likely be a fixed or variable cost. Which would be more likely? Okay. Shipping costs for Amazon.com.
Variable.
Variable. Cost of fuel used for a national trucking company.
Variable.
Variable. Sales commissions at a car dealership.
Variable.
Variable. Monthly office lease cost for a CPA firm.
Fixed.
Fixed. Cost of fruit sold at a grocery store.
Variable.
Monthly insurance cost for the home office of a company.
Fixed.
Fixed. Cost of fabric used at a clothing manufacturer.
Variable.
Variable. Monthly rent for a nail salon.
Fixed.
Depreciation of exercise equipment at the YMCA.
Fixed.
Now somebody asked, well, what method are we using? Always assume we're using straight line unless it states otherwise. Okay? So if it is straight line, what is the answer to 9?
Fixed.
Fixed. What is the method of depreciation that if we used it, depreciation would be variable? Does anybody remember?
Accelerated.
Not the accelerated method. That doesn't change in relation to level of activity. It's that other one.
Accumulated?
Hmm?
Is it like the accumulative one or something like that?
Units of production. Do you remember units of production? Okay. But like I said, unless it states otherwise, assume straight line. Okay. Because it by far is the most common. So that's fixed. Hourly wages paid to sales clerks at Best Buy.
Variable.
Property taxes for a restaurant.
Fixed.
Cost of coffee used at a Starbucks store.
Variable.
Monthly cost of French fries at a McDonald's restaurant.
Variable.
Variable. Salary of the accounting controller.
Fixed.
Fixed. Okay, is there any questions on any of those? Any that I need to kind of explain to you? I'm happy to do that. All right? Okay, being able to classify costs as fixed or variable is very, very important. Okay? Let's talk about a different way to classify costs. Let's say I classified costs by traceability. Okay, and we talk about direct costs versus indirect costs. Okay? Direct costs are costs incurred for the benefit of one specific cost object, whereas indirect costs are incurred for the benefit of more than one cost object. Let me give you an example. Okay, pull off the slides for a second. I don't know if you can see this, but let's say that I manufacture this chair right here. My company manufactures this chair, and they also manufacture these kind of wooden podium things. That's the two things we produce, okay? Now, some examples of some direct costs. If I purchase fabric, I clearly know it's going towards production of chairs, correct? If I purchase lumber, clearly for the production of podiums. Those are direct costs, okay? Right? Now, let's say that Jeremiah assembles chairs. Well, he would be a direct cost because you are assembling chairs, right? Let's say that you only know how to put podiums together. That would be a direct cost because it's clearly going to podium. Now listen here. Let's say that Daniel knows how to produce podiums and he also knows how to produce chairs. I want you to understand that even though he can produce both, he would still be direct labor and a direct cost because I can clearly tell at any point what he's doing. He's either working on podiums or he's working on chairs. Does that make sense? Mm-hmm. So all three of you would be direct labor. Let's say Ling Fei, though, is your supervisor. She doesn't produce chairs or tables. She walks around. She might answer questions as needed. She fills out, purchasing orders. Every now and then she'll clean up or something like that. She just kind of manages the factory. Do you see where she would be an indirect cost? Because at any given point in time, it's not directly clear, is this going towards podiums or chairs? You with me? Does that make sense? Okay. We'll talk about more direct versus indirect costs a lot more in the next chapter, but I at least want to touch upon it here. Okay? Let's go toward the next way we can classify costs, which is by controllability. This is how much control that you have on a specific cost. There are some costs in our life that we have a lot of control over. Same way with a business. And there are other costs that we have very little control over in our personal lives and in the business as well. And then there's certainly a lot that fall in the middle there, okay? Okay, let's go back to the example of Matt and his wife. Matt, let's say that you're having a lean month, money-wise. What is a cost that you have a lot of control over that you could decrease drastically or maybe even eliminate for a period of time? Is there certain costs in your life that you could do that with?
I like going out to eat.
Going out to eat is the classic one, right? If my wife and I are ever short on money, we say, well, we're not going to go out to eat this month, right? You have a lot of control over that, correct? Now, think in your life, so that would be, looking at this illustration, that would be up here. You have a lot of control over that. That'd probably be right up here, right? Okay? Now, what would be a cost in your life that you have very, very little control over?
Rent on my lease.
Very, very good example. Your monthly rent, right? If you're in an apartment and you're paying $900 a month, well, you're locked into that lease for 2 years. You don't have a lot of control over that, do you? Now, I guess you could try to break the lease. But that would be a lot bigger deal than just saying we're not going to eat out, right? So that would be, looking at this little pyramid, that would be down here, right? You have very little control over it, okay? Now, there's some examples of things in the middle that you have some control over, but not ultimate control over. I think 2 examples of that might be your groceries, okay? Now, you can cut down on the groceries that you eat. Maybe you can use coupons. Maybe you can go to Aldi's instead of Hy-Vee, right? But ultimately, you have to eat, right? You do have to eat, okay? Same way with gasoline and your fuel costs for the month. You might decide not to go visit your grandmother in Iowa, okay, because you don't want to pay the gas costs, okay? But you still have to drive to work and drive to school, right? So you have some control over it, but not ultimate control over it. Does that make sense? It's the same way with the business. Business have certain things like, man, this is a lean year. We're not going to have the holiday party that we usually have. We're going to save that money. And then there's other things like, well, we're renting our factory for 10 years at this contractual cost. And then there's a lot of things in the middle. You with me? Okay. So one way we can classify costs is how well we can actually control them. Okay. Another way we can classify costs is by relevance. I think this is a fascinating area. Opportunity costs. Now, you may have talked about opportunity costs in econ. And I don't know, I don't remember enough from my econ classes where they might treat this a little bit differently. Okay? But opportunity costs in accounting is the potential benefit that's given up when you choose one alternative over another. Okay? Is that the way econ does it? Okay. For example, what are you giving up to be here at class today? Think about this. Come off there. All of you are giving up something to be with me here today. And we have full attendance today. Everybody decided to be here. What are some of the things that you have given up to be here?
Sleep.
Sleep. Right? You've given up sleep. Correct? Okay. So you're giving up something. What else have you given up?
Time to work.
Time to work. Let me ask you this. Is there anybody here that if I would have canceled class today and told you last class period, no class today, is there anybody here that literally would be at work now? Okay. Okay. Daniel? All right. Where do you work?
Jose Peppers.
Okay. So I don't know how much you make at Jose Peppers, and I don't want you to tell me. Okay. But let's just say it's $12 an hour. Okay. Well, I know that you at least feel like being here is worth more than $12 an hour, correct? Otherwise, you'd be at Jose Peppers. Am I right? Okay? So, you are giving up roughly $12 to be here for this class hour. Okay? Now, what if your boss would have told you on Wednesday, Daniel, I need you to come in on Friday, which is today. I need you to be at Jose Peppers today. Can you skip that class? And you say, I don't want to skip it. It's my favorite class. My professor, he's brilliant. He's probably the best teacher I've ever had. I don't want to miss it. And your boss said at Jalapenos, I tell you what, Daniel, I really need you to skip that class and come into work. If you come in, if you skip that class, if you'll come work that shift and miss your class, I will give you a $500 bonus. Now, would there be anybody in your chair today? No. Because the opportunity cost became too great. So I don't know what I'm worth in your life, but I know it's more than $12 an hour and less than $500. It's somewhere in there. And if we really analyzed it, we could, you see what I'm saying? That's fascinating to me. Okay? But we all do this. We do this all the time. And we do this hundreds of times a day without even thinking about it, right? Mackenzie, there are times that you miss class because of what? You have to play soccer. Because the cost of you skipping a game and having the coach be mad at you, it's not worth it. Correct? All right? There's a reason LeBron James didn't go to college. There is a reason Andrew Wiggins decided to only play 1 year at KU. Because the opportunity cost of Andrew Wiggins coming back for a second year of college was just too much, right? It was just too much, okay? But we do this all the time. Every decision we make, we do a cost benefit on. What's the opportunity cost of me making this decision? And it's kind of just fascinating to me how we do that, okay? Does that make sense? Is that the way econ describes it? I don't know what they're doing over there in econ anymore. All right. All right. Another fascinating subject to me is the concept of sunk costs. Sunk cost. What is a sunk cost? It is a cost that is incurred in the past. It cannot be changed by any decision now or made in the future. And thus the interesting thing is sunk costs should not even be considered when we make decisions. You with me? Let me give you an example. Now, they tested this, and I'm not sure how they actually tested this little example that I'm going to tell you about. But I read about this because this is an interesting subject to me, okay? Okay. Does anybody here like to snow ski? Okay. Michael, Luke, you guys like to snow ski? Okay. Luke, let's say that you purchased, let's go to the document camera. Let's say you purchased an all-inclusive ski trip for the first week of February, okay? And that was, let's say that was to Winter Park, okay? I've been to Winter Park ski area, right? It's a very nice ski area. And let's say that you paid $700 for this, okay? For the first week of February, okay? You've paid that already. It's non-refundable. You can't transfer it to somebody else. You can't get it moved to a different date. You with me? Okay. Now you love skiing so much that you also booked a ski trip for the third week of February, and that was to Vail. Okay. Anybody ever skied at Vail? It's a little more ritzy, isn't it? Okay. And let's say that you paid $900 for that all-inclusive trip. Okay. Once again, you have paid that. You can't get it refunded. You can't get it transferred to somebody else. You can't sell it. You can't change the weekends or anything. So you understand your situation here, Luke? But here's the catch. You made a mistake. You thought you were booking this for the third week, but you made a mistake and you actually booked this for the same weekend as this one. Okay? Now these are far enough apart where you can only do one. Now let's say that when push comes to shove, you actually enjoy Winter Park Ski Resort more than Vail. You have more fun there. You like the people there. You like the ski slopes better. You like Winter Park more than you like Vail. But you can only go to one of these places. Do you know what, statistically, Luke will probably choose to go to?
Vail.
Vail. He'll choose to go to Vail, even though he enjoys Winter Park more. He'll choose to go to Vail because he paid more for it. Whereas that's a fallacy of thinking. The way that he should consider this is that he spent $1,600, and there is nothing that he can do. He can't, unless he invents a time machine, like Marty McFly. Do you guys even know that movie? Okay, thank you. Unless you invent a time machine, you spent $1,600. There's nothing you could do. It doesn't matter what you spent for each. You spent $1,600, and you can go to this one or this one. You should go to whichever one you enjoy most. Does that make sense? Okay? Sunk costs fascinate me because there are people in life and there are people in businesses who will continue to make bad decisions based on something that they did in the past. All right? For example, I've known people who are in married relationships and they're like, I should not have married this guy. This guy is a jerk. We do not get along. We fight all the time. The marriage stinks. And I wish I'd made a bad decision 5 years ago. And I'll say, okay, well, what are you going to do about it? Well, I think we're going to try to have a baby. Maybe that will bring us together. That's a bad decision. Now we laugh, but people do these things. Or here's another one. I've talked to people who are seniors in their chosen major. And they go, I hate this major. I do not want to do this for a living. I hate it, I hate it, I hate it. I go, why are you doing it? Why are you going to finish out the year? And why are you going to graduate in this? Well, I have to. Because I've already gone through these first 3 years. No, you don't have to. This isn't a communist country, right? You don't have to do that. But there are people who will continue down a road. Do you see this? Because of something that they have done in the past that was, well, there's nothing you can do about that, right? Okay? I'll try not to get too preachy here. I won't get my reverend hat on. But I have people I've taught for many years, and I have people who come into my office. I've had more people cry in my office, including me, than I even can count. But I'll have somebody come in, like a 20-year-old, and she'll say, I've made all these bad decisions in life, and there's nothing I can do. All my mistakes you can't make up. And I'm like, okay, all your mistakes, you're young. You got plenty of time to make up for them. I said, and they'll, maybe they went through a bad marriage, or maybe they had a kid that wasn't planned, or maybe, whatever, okay? Or maybe they dug themselves a GPA hole, or maybe they have some debt. And I always try to tell them, okay, we can talk about the past for a little bit, but there's nothing we can do about it. Every decision here is from what you do from this point on in your life. That we control, right? So don't spend energy ruining all those things that you wished you wouldn't have done. Let's go forward. What can we do now to make your situation better? Does that make sense? This all has to do with sunk costs, and it's very relevant, okay? See how managerial accounting is more touchy-feely, okay? I feel like we should have a group hug when the cameras stop rolling. Okay, maybe not. All right. Now, let's talk about something, and I know your minds are tired. At home, pause if you want, okay? Go take a little walk around your house, then start us up again. Because this is an important topic that we're going to go to now. This is the concept of product versus period costs, okay? This is so important. Please give me your brains for 10 more minutes. Okay? Okay, we can classify costs as product costs, and we can classify costs as period costs. Product costs are costs incurred to manufacture the product. Factory costs, sometimes we call them. Period or not. Okay? There are 3 types of product costs. There is direct materials, which I'll abbreviate DM. There's direct labor, which I'll abbreviate DL. And there is manufacturing overhead, which I will abbreviate MOH. Now, sometimes that's called factory overhead, and that's the same thing. Okay? But those are the 3 product costs. We can classify it this way or this way. If it's a product cost, it has to be one of those. Are you with me? Okay. Let's go back to the slides. There are our 3 product costs: direct materials, direct labor, MOH. What are direct materials? These are raw materials that become an integral part of the product, and they can be conveniently traced to it, such as the tires on an automobile, right? Tires on an automobile are direct materials for it. They become part of the auto, and they can be easily traced to it, right? You have 4 tires on an auto, correct? Direct labor are the labor costs of the people who are producing or assembling the product. Sometimes we call this touch labor, because these are the people actually touching the product, like this guy working on this car. When I talked about you guys working at the podium in the chair factory, you guys are direct labor. You are assembling it. And then there's this other category called manufacturing overhead. Now, also called factory overhead. These are all factory costs that cannot be traced to specific units produced. In other words, these are all factory costs that aren't DM or DL. These are all product costs that are not direct materials or direct labor. Okay? Some examples are factory utility costs, okay? They have to cool this factory. That would be a product cost, and it would be manufacturing overhead. Factory maintenance costs, like this guy cleaning it up. That's a factory cost, that's a product cost. He's not assembling the product, so it's not direct labor, it's not direct materials, so it's got to be MOH. Indirect materials and indirect labor are always part of MOH. They are product cost and part of MOH. What are indirect materials and indirect labor? Well, an example of indirect material might be, let's say you buy some Armor All, and when you're done with your automobile, you shine it on these you spray it on these tires, and you shine those tires all up. Well, the cost of that Armor All it's what we call an indirect material. Technically, it does become part of the car, doesn't it? But can it be conveniently traced to it, like the tires can? No. So it would be an indirect material. It'd be a product cost, but it'd be part of MOH. Indirect labor would be the factory supervisor, such as Ling Fei in the earlier example. She's not producing the product, but she's supervising the factory. Okay? Now, let me give you a Dave Krug special here. This is not in your book. One of the most important things you're going to do is classify costs as product or period. Okay? If you see one of these 4 words here, you know it is a product cost. You know, you know, you know. If you see the word factory, If you see the word manufacturing, if you see the word assembly, or if you see the word production, if you see one of those 4 words in the cost description, you know it is a product cost. Now listen to what I'm saying, and I want you to hear what I am not saying. This is important. I am not saying that all product costs have these words in it. But I am saying if you see one of those words in it, you know it's a product cost. Can you tell the difference between what I just said? Okay? If you see one of these 4 words, you know it is a product cost. And then once it's a product cost, you've decided that, then you just need to determine which one of these it is. Let me give you some examples. Let me list out some cost items and you tell me if they're product cost. Toilet paper used in the factory bathroom.
Yes.
Yes, because you heard the word factory. And as soon as you hear the word factory, you know it is a product cost. Now, is it direct materials? Does it become part of? No. Is it direct labor? Of course not. So it's got to be part of MOH. A lot of times things become MOH because we know that they're a product cost, but they're clearly not direct materials or direct labor. Does that make sense? Like a broom used in the factory. That's a product cost because you heard the word factory. It's not direct materials because it doesn't become part of the product we produce. It's not direct labor, it's got to be MOH. Okay? Toilet paper used in the accounting bathroom. That's not a product cost. Okay? We'll see that's a period cost. And the accounting bathroom is usually nicer than the factory bathroom too. Just as motivation for you to get your accounting degree. Okay? But do you see what I'm saying? If you see one of these 4 words, it is a product cost, one of these, okay? Now, what are period costs? Your period costs are your selling and your general administrative costs, okay? So, your period costs are your general and administrative and your selling. Let's go to the slide. They kind of describe those. Selling costs are those necessary to get the order and deliver the product, such as advertising. General administrative, this would be like your accounting department, your human resource department, all your executive salaries, those sort of things, clerical things. You with me? Cool? So important to be able to classify between product and period costs, and I will tell you why next time. Let's do in the minute we have left, don't play the music or anything, but let's look at this slide and in your brain answer this question. Which of the following costs would be considered a period rather than a product cost in a manufacturing company? Okay, go through that. Just take 15 seconds in your brain. Okay, let's just go through these. First one, is that a product or period? I see the word manufacturing. The argument is over. It's a product cost. Second one, property taxes on corporate headquarters.
Period.
That is a period cost. Direct materials costs. That's product cost. Electrical lights to light the production facility. Product. Sales commission. Period. Okay, so the only 2 period costs were B and E. Okay? All right. Here's what I want you to do for homework, folks. I want you to do this handout. I'll give this to you when the cameras are done rolling, guys. You folks at home, you have this as well. I want you to do the product versus period costs handout. Do the whole handout. And I also want you to do exercise 18.1. So do this handout and exercise 18.1. And remember to do those little mini projects on Connect for chapter 16 and 17. Don't put those off. Go get those done. Okay, look at the due dates on Connect. Okay? Any questions? Have a good one, guys. We'll see you later. Bye-bye.